This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers ownership investments, lending investments, liquidity, futures, options, precious metals, and collectibles. Please note that in creating the book, the author offers his opinion. In creating these videos, I have done the same. Our opinions do not constitute specific investment advice. While there are many ways to build wealth, our author, who is a noted financial counselor, believes that the best way is to live within your means. That means that you do not spend what you do not have. If you make $40,000 per year, you live on far less, saving and investing the surplus. What should you invest in? Our author recommends stocks, real estate, small businesses, and your career. Of course, investing in stocks, real estate, and your own small business involves risk. If you don't mind a bit of a roller coaster ride from time to time in your investment's value, these ownership investments offer a good potential return on investment and may be ideal for you. Stocks are equity instruments because they represent ownership in a corporation. If you own 1,000, or 1,000,000 shares of a corporation, you're a part owner. Stocks and ownership have risks, but they also have rewards. The top chart here is a 10-year chart for Apple. Can you believe that Apple traded at under $10 as late as 2003 and was under $100 in 2009, but trades for around $350 in 2011? Smart investors made millions of dollars on Apple. The bottom chart is Ford for the same 10-year period. At one point in 2001, Ford traded for over $30 per share. Since then, the stock dropped to under $2 per share in 2008 and 2009, but rallied to over $15 per share in 2011. Depending upon when you bought Ford, you might have made or lost money. If you bought at $30 in 2001, you've lost half of the money you've invested. If you bought at $2 in 2009, you've made over a 7-fold return on your investment. As the author points out, real estate has risks and rewards. Overall, owning and managing real estate is a lot like running a small business. You need to satisfy customers, your tenants, manage your costs, keep an eye on the competition, and so on. Many people are afraid to get involved with real estate since the recent decline in housing prices. There are good opportunities out there, but there are significant risks as well. Owning and operating your own business is the dream of many people. They yearn to go out on their own, make their own decisions, do the hard work, and reap the rewards. While most people who invest in stocks and real estate do so only part-time, many small business owners work full-time developing and running their businesses. Lending excess capital by purchasing CDs or bonds is another investment strategy, but one that typically does not offer a good return on investment. CDs and bonds offer a published rate of return, so unlike stocks, investors know how much they will make going into the investment. However, the rate of return is usually very low. In early 2011, most one-year CDs paid less than 1.3% interest, most three-year CDs paid less than 2% interest, and most 5-year CDs paid less than 2.5% interest. A 10-year government bond paid about 3.6% interest. These returns are extremely low and may not even be enough to offset inflation, meaning that it is possible that after investing and earning returns, the investor could have less buying power with his or her money after investing than before. We'll take a closer look at bonds in a later chapter and see that there are some bonds that pay a higher rate of interest. However, they also come with much higher risk. On the whole, lending instruments typically aren't good at building wealth and are much better for storing it. We know that in financial terms, liquidity refers to the ability to convert an investment into cash quickly and without cost. Stocks offer high liquidity because they can be traded in the market very quickly and converted into cash in a day or less. Bonds offer a similar liquidity, as we do not have to hold the bond to maturity, but can instead sell it to another investor for cash. CDs require us to commit our money for a set period of time. We can access our money early, but only if we're willing to pay a steep penalty. Small businesses and real estate do not offer good liquidity. To sell them usually takes quite a bit of time. It pays to keep the liquidity of an investment in mind if you think you may need cash quickly. A future is a contract. More specifically, futures contracts are forward contracts, meaning they represent a pledge to make a certain transaction at a future date. Futures are standardized, transferable, exchange-traded contracts that require delivery of a commodity, bond, currency, or stock index at a specified price on a specified future date. An option gives one the right but not the obligation to buy or sell a specific amount of a given stock, commodity, currency, index, or debt at a specified price during a specified period of time. Options and futures have their place in the diversified portfolios of sophisticated large investors, but are not traded by the average investor and will not be covered in this introductory class. Gold and silver may offer a hedge against inflation or currency devaluation, but they're not generally considered good long-term investments. As the author points out, investing in gold or silver is better than keeping your money in a piggy bank, but the investment returns over the long term aren't as good as stocks, bonds, and real estate. Of course, gold has been a good investment over the past 5 years, appreciating more than double. The chart shown here is for the Exchange Traded Fund GLD. An Exchange Traded Fund, or ETF, like GLD, is a way to earn returns on an item without needing to hold or store the item. The GLD ETF mirrors the increase or decrease in the price of gold. One advantage of ETFs is that they trade during the market trading day and offer a way to quickly convert investments into cash. If you wish to participate in the precious metals markets, you may want to consider ETFs. Collectibles such as baseball cards, art, coins, comic books, and autographs are fun to collect, but are risky as investments and rarely offer worthwhile returns. Nothing is wrong with spending money on collectibles as long as you enjoy them. Just don't consider them to be investments because they may or may not pay off in the long run. That is the end of this presentation. I hope you enjoy reading the chapter.